DraftKings had earnings last week and knocked it out of the park. Revenue rocketed 81% year over year to $855 million in the fourth quarter. It was fueled by the launch of its Sportsbook in recently legalized markets. The company now has mobile betting operations in 20 states that together account for more than 40% of the U.S. population.
Hey guys, Darren here. Thanks for joining. We talk about action steps you can take today to increase profits and reduce risk in your options trading portfolio. Please check out and download the free options workshop in the link below.
It talks about the two main reasons why options can be less risky and more profitable than just buying stocks alone. It also details how to profit in both directions and pick your win percentage, which you can't do with buying stocks alone. Please hit the like and subscribe buttons below. I appreciate it, and it helps get the video out to more people. Disclaimer, I'm not a financial planner, and I'm not recommending trades. Please do your own research, and if you're new or learning, I recommend you start small. More states continue to legalize online betting as they need the tax revenue, so that will continue to fuel growth for companies like DraftKings. DraftKings is also getting great at acquiring and retaining new customers. Its monthly unique paying users recently jumped 31% to 2.6 million players. DraftKings is continually becoming more profitable. It cut its operating loss to $232 million from $369 million in Q4 of 2021 and EBITDA loss to $50 million, down from $128 million in the prior year period. What's next for DraftKings? Well, DraftKings management is pretty confident. They lifted their 2023 full-year revenue guidance range to $2.95 billion, up from a prior estimate of $2.85 billion. That would equate to a year-over-year growth of about 32%. I definitely think that is possible at the rate they're going. What's the best way to trade DraftKings using options? Let's go to the Tastyworks trade platform. It's the best platform for trading options. I'll put a link down below. We punch in DraftKings DKNG in the upper left and see that the IV rank is very low at minus 8.1. It's hard to sell options in low IV and collect good premium, so we will look to buy a LEAPS option. This is a bullish trade since we think DraftKings will continue to go up in price. We look at the option chain on the trade tab. We pick the January 2025 option chain since it's closest to 2 years from expiration. We then go to the table mode and look to buy the deep in the money 10 call option by clicking on the ask. We pay $13.20, which is really $1,320 since one contract is equal to 100 shares. We go deep in the money to bring the cost of the option down. With the current stock price at $20.54, we buy the 10 strike option for $13.20. Think about it. There's already $10.54 intrinsic value built into the option. The current $20.54 stock price minus $10 is $10.54. Since we're paying $13.20, it's really like buying the option for $13.20 minus the $10.54 or $2.66. What a deal. We switch to the curve mode by hitting curve on the trade tab. It's a little more visual and you can see the profit zone in green. So we are buying the 10 LEAPS option with 699 days to expiration. This doesn't mean we need to hold the option that long. We can sell the option whenever we want prior to that date. Because we are going deep in the money, the LEAPS option value will closely replicate the profit and loss of owning 100 shares of stock outright. We continue to make money as the stock moves up in price. From here we hit review and send and check to make sure everything is correct as it should be. We then send the order to place the LEAPS option trade. Now let's take a closer look at some of the parameters and break down what we are doing. When we set up, we buy the deep in the money call option 2 years out or days to expiration. The directional assumption is bullish. As long as the price moves up, we continue to make money just like we own the 100 shares of stock. The implied volatility environment should be low. We pay less for the option when IV is low. As you can see, the IVR of DraftKings is minus 8.1, which is about as low as it can get. So we pay less for the option, so it's a great time to buy LEAPS. Max profit is the potential for a LEAPS option is infinite. The stock price can move up infinitely. Buying power effect and max loss. The buying power effect is the amount of capital that is required to place the trade. Or in other words, it's how much capital the trade is utilizing. Since we are buying the LEAPS option, the amount we paid is the max loss, and it's also the amount of buying power required to place the trade. So it is a defined risk trade. This is the beauty of the LEAPS option over buying 100 shares of stock outright. The cost to buy 100 shares of DraftKings at $20.54 would be $2,054. So the $13.20 is just a little over half the cost to control the same 100 shares. If the stock did move against us down, that's the max loss. So we could lose much less than if we owned the 100 shares outright. So the LEAPS option is a cost-efficient way of investing. We are able to control the 100 shares for about half the cost while limiting our downside risk. At the same time, our upside is uncapped. Now is a great time to consider buying a LEAPS option in DraftKings.
All right, guys, I put a link down below for the free options workshop. Be sure and grab that. Also, let me know what you thought of this trade and what you're trading in your options trading account. Thanks for watching, and see you in the next one.